Hey Tom, how's it going?
Yes, good. Thanks, mate. You?
Yeah, fantastic, thank you. How's it going? We have the jobs data, not jobs data, inflation data that just landed.
Inflation. Yeah. It's all coming in line, to be honest. So like, there's no real surprises or anything like that. Um, it's this is probably the local bottom for inflation. I'd say in terms of the data, we were trending down quite nicely over the last I think it's like 4 or 5 months now. Um, But and again, that's why the market probably hasn't reacted that much to this data really because it's out. Even though it's February's data, it is outdated now just because of what's happened since in terms of the conflict in the Middle East. So you're going to see like a sort of big move up in the inflation data over the coming months because of these higher oil prices. It depends if Trump can get the oil prices back down again, but it just doesn't look like he can really do a lot, and the Iranians don't have to actually do much to keep the prices of oil like very high, which is probably one of the big sort of weapons that they have against the US at this moment in time. But I'd say the short message is this: is that inflation is going to be higher over the coming months, probably even Q2 and maybe even Q3. Um, the Fed will choose or will try to choose to look through it somewhat, even though this does push cuts out. The Fed will try to look through it as long as it stays in the headline number. But if it starts creeping into the core number, um, then that's when it's a bit more of a problem, and they can't really use the transitory line or anything like that. But ultimately, I think this just pushes rate cuts further out. I don't think you get anything close to June or July, and it probably earliest will be September, earliest. And you're probably looking at one cut this year. So overall, it's not supportive for risk assets this moment in time.
Okay, yeah, that makes sense. You talked about the market looking through data. Can you explain what you mean by looking through data and how it's actually decided?
So in this scenario, the market looks through today's data because it's February's data. It's the data from February. And obviously, the conflict in the Middle East didn't start until like 10 days ago or whatever it was, 11 days ago. So that would have been the first day of March or the last day of February, whenever it was. Um, so essentially, this is February's data, which doesn't account for higher oil prices, which is what we've seen in the last like week or two. So the inflation data going forward is going to be much more elevated than February's data because of those higher oil prices. So the market will sort of look through, that's the term, look through February's data as okay, that doesn't include these higher oil prices. We're now in a different environment where we have this conflict going on. A lot of the oil production has been cut. Oil prices are going to be substantially higher. This is going to creep into to everyday prices, whether it be through fuel, anything that is made it uses oil to be produced. So the data going forward is going to be substantially higher on the inflation side. Um, and that's going to be the case whilst oil is high. So the February data is just outdated, even though it is the most recent data point. It is just outdated because of what's happened since.
Yeah, that makes sense. And I suppose we're at a stage where it's inevitable that inflation does increase. I believe in your report you said potentially by July getting to 3 to 3.5%. But how do you expect this to happen? Are we going to see a big jump when we look back at March's data, or will this be a staggered increase over the next couple of months?
So it will be a staggered increase, but not that staggered. Like you probably will see it quite substantially straight away in March's data, which obviously comes out in April. Um, but it just depends what happens with oil prices. If they come straight back down again, which I don't think they will, but if they do come straight back down again, then obviously you might only see one or two hot inflation prints before it then rolls over again. But the chances are with this conflict ongoing that and it does look as if this is just going to be ongoing for a while. If anything, it looks like the US and Israelis want to pull back more than the Iranians. Um, but essentially, I think this is going to show up in the data over the coming months. So it might be the case in the next print we get a 2.7, 2.8% print, and then it's like a slow grind up from 2.8% up to sort of 3.4, 3.5 by the summer.
That makes sense. And you mentioned obviously when you look beyond the oil chart, oil is used in everyday life. That's what
Yeah,
causes the inflation. It's not just the price of oil itself, is you need oil for everything, whether that's, you know, p producing electricity, whether that's for fueling your car, whether that's for heating, etc.
planes.
How much? Yeah, exactly, exactly. Although, is it kerosene that
It's
fuels planes?
it's jet fuel, but jet fuel is like the oil can be refined into
Mm.
lots of different types, but jet fuel is like one of the real like premium ones.
Yeah, absolutely. And I suppose gas too, right? People are focusing
Yeah.
on oil quite a bit, but we can touch on gas later. When it comes to inflation here, how much of this is strictly oil versus how much of this is the second order consequences of everything else increasing?
Um, So this will be inflationary in the short and medium term because of the price of oil, but it will be deflationary over the long term because it raises prices again. Consumer spending pulls back. Essentially, if prices are going higher for oil, it's inflationary in that short term. But the prices going higher is painful for consumers, for businesses, etc. They will all pull back on spending, hiring, acquiring, whatever it is. Um, so you're probably going to see these higher oil prices keep the Fed on pause for longer than what we anticipated going into this year. And you're going to see the spending slow down, more meaningfully. So really, I think this keeps the Fed on hold for longer. But once this effect, so assuming that this war ends in the coming months, or is a big de-escalation in the coming months, you're going to have the price effect of oil being high for a few months, and that's seeping through to some of the prices going into, say, the summer, end of summer. But you're then going to have the Fed try to look through that and look to cut towards the back end of this year, or late Q3, back end of this year. And when they do start cutting, it's likely that the consumer will be very weak at that point because they'll have to dealt with you're dealing with these higher prices, so that the spending will be lower, etc. So when they do come to cuts, it pushes cuts out. But when they do come to cut rates, the Fed, they're probably going to cut more aggressively. So I think that's when you get your risk on period for risk assets in total, crypto more meaningfully. And I think it depends who you are, but I think people should see this as a potential positive because prices can come, assuming you're out the market, prices can come down lower in the short and medium term, which on the other side of that gives you greater upside the other side. So I think this only aids my view, especially that um, this is just not constructive for risk assets at all. So I think prices do come down more meaningfully, probably for Bitcoin into that 50-60K zone. Um, but on the other side of that, if you do get more aggressive cuts towards the back end of this year and then into 2027, you're probably going to see meaningful, upside from mid 50Ks, for instance, going up. It'll probably produce a new bull run. Not probably, maybe not a 2-3 year bull run, but I don't really know 3 years on from this. But I would say that's the next sort of 3 to 12 month setup. Is that you've got more sort of pain in the coming months as the Fed remain on hold. The market will look through this going into the summer. So yeah, and that's when Bitcoin might be considerably lower, and in that buy zone, or the on chain levels are in the 50Ks. Um, and I think that's the buy to hold into the cuts at the end of this year and into 2027. And Bitcoin will see, good upside into that, whether it hits 100K or 90K, or it hits 120K, or it hits 150K. I'm not sure. That's something that we'd look to assess closer to the time. But I'd say that's the the setup I'm like looking at the minute.
Yeah, that makes a lot of sense. Um, a lot of this depends on how long oil stays elevated. And of course, when you're
Yeah,
following the headlines, it does seem like this is something that will continue to extend. However, what could invalidate this? If the strait is opened up in the next couple of days, if they reach some sort of resolution, if the US can, perhaps set something up where they're a bit more in control again, and we see oil pull down, will this even be reflected in next month's inflation print? Slash, will it even matter?
Yes, so it will be. So there's things they can do. In terms of the strait being closed, I don't think that reopens anytime soon, or any deal is done there anytime soon. I think the Iranians know that that is a pain point for the US, and it actually doesn't cost them a lot. It costs them a few drones targeting a few ships to stop every other ship coming through. So really, it's very low cost and very effective, to be honest, as a weapon. So I don't see. I think the Iranians know this and are like holding on to that now. So I don't see that being something that Trump can really resolve. He can in some ways get U.S. military vessels or ships to protect these vessels going through the strait, but again, the vessel itself has to be like, yeah, cool, we'll take that, thanks very much. And then all of a sudden, they're just a walking or sailing target. So I don't see that really being the case. What we have seen is that I think G7 countries have come together, and some other countries have come together to release barrels of oil that was in their like strategic reserve. So this is the moment where you've stockpiled your. So throughout the years, you stockpile barrels of oil in the strategic reserve, and when something like this crops up, you have enough stockpiles there to release that into the market, and therefore helps bring prices down. I think that's why prices is down yesterday and today,
Mm.
based off that. But ultimately, and I was reading something again today that they can bring. I think they can bring on. I don't really want to say the numbers because I can't remember exactly what the numbers were. And again, I'm not an expert on this. But it's a lot of the output has closed down, and bringing that from the strategic reserve into the real world market, it's not something that can just happen like that. Like what we can do with the internet and stuff. That's not the case. Bringing the real world barrels of oil into the real world and getting them out to where they need to go to takes a lot of time. So there's still that massive gap in terms of daily demand and then the supply. So with that being still like a significant gap, it just sort of pushes prices higher. So that news is what's kept prices lower yesterday and today, like in the mid 80s, high 80s. But ultimately, I think this just resolves the upside when you have these capacity issues, supply issues, because there is still the demand for it. There's just a huge supply issue at this moment in time. So I think even though the strategic reserves are releasing these barrels, I think it's going to be time before they actually make their way into the system. So again, that pushes prices higher. Then it comes to the third point, which is what you talked about in terms of resolution of the war. It seems to me at the moment that just doesn't seem likely because neither side. It looks to me like the US are looking for an off ramp more than the Iranians, and I don't see these off ramps. If Trump just pulls back now and calls it a victory, I think everyone knows it's just not a victory. But
Mm.
um, it's hard to really know what that off ramp is going to be. So at this moment in time, I really sort of don't see how this comes to an end in the near term. It's in a month's time we could be in a completely different story, but in the near term, I just don't see how this happens.
Yeah, that makes sense. And you touched on the G7 countries kind of releasing reserves, but I guess ultimately that's a short-term solution to a long-term plan. And ultimately, they will have to continue to build their reserves again. So, you have to prepare for these situations. So even if
Yeah,
the resolution came sooner rather than later, you're still going to need to start putting some supply on standby just in case something happens, which should keep prices elevated. However, we can move from there. I mean, let's go over, is there a particular correlation you can draw between expected um, print, like inflation print, and price of oil? So we're in the 80s now. If I was to come to you and say, Tom, look, it's April 15th and oil's at $96 versus it's at $126, would that have a big impact on the next print? It should
yeah,
do, but I'm just curious.
yeah. So again, I'm not an expert in this area. I'm looking at macro to help work out general liquidity and therefore crypto. So I'm not an expert in the inflation data, labor market data, or oil, but I do like a ton of reading on a lot of it. Um, so I do have to go to the experts to get those like specific things. I'm much better at labor market and inflation um, data in terms of their relationship, but in terms of oil, yeah, ultimately it brings the inflation rates much higher. But there's other components within that basket that makes up the inflation prints. So yes, you could model it out, and there's people that we can go to that will show us what it would look like. Ultimately, I don't have the numbers to hand, or would have the numbers to hand.
Yeah.
I have to go to these people. But assuming the other components stay the same, yes, like an oil price $30 a barrel higher is going to see the inflation data go through the roof. So, or just be substantially higher at least. But in terms of numbers, I can't put like straight numbers on it at this moment in time. Again, it's not my field. But overall, it's about the impact of it. There's the rate of change in the path, and with the price going up substantially, that increases that rate of change for inflation moving up, and moving up in a more rapid way. Um, Again, what's the effects of that on interest rate cuts, general liquidity, consumer spending? To then work out all those bits. Ultimately, what it comes down to is that it's bad for inflation. Inflation goes higher. The Fed remains on pause, and if I think in a more simple way, looking at it in terms of the headline inflation number will be high, but the higher oil price might not work its way into the core element of inflation.
Mm.
If the price of oil stays high for a more significant period of time, like multiple months, then you're going to see that work its way into the core inflation um, metric, or data point, and that's when the Fed would have a real problem, like cutting rates. So they then can't really say it's transitory inflation, i.e., we'll
Yeah.
look through this, blah blah blah. We expect this to come down. That's I would say for more simplified market participants. That's the thing you want to be
Mm.
watching. But in a much more simpler way, you're looking at higher inflation over the coming months, pushes Fed rate cuts out, generally bad for liquidity, bad for consumer spending, and therefore you're going to see a tightening over the coming months, and this Q2 and Q3, a tightening on the consumer, a tightening on liquidity, the Fed not really being able to do a lot in terms of that general liquidity. So overall, the backdrop is just not supportive.
Okay, that makes sense. Could you quickly explain the difference between headline inflation and core inflation?
Yes, so headline inflation and core inflation, they're different in that core inflation takes out all the volatile parts. So like oil is a very volatile component of inflation. So core sort of it's looking at it on a I believe it's done on an average, but essentially it removes those more volatile um aspects. So it's looking at the more core. So core inflation looks at those elements that aren't more volatile in price swings. So it gives you a sort of it's a better measure. Essentially, it's a measure that's not going to be whipped around so much because, i.e., oil
Mm.
prices is going through the roof, or falling dramatically.
That makes sense. How is the Fed supposed to respond to this inflation issue that's inevitable? Because of course we saw the weakening labor market also. What's their playbook right now?
So I think just to sit tight. Um, I think we saw Jim Bullard go on yesterday. I think he had Bloomberg interview yesterday, or it was today. I can't remember which day it was, but he was basically saying the Fed will just look through this for now. Like this has been a thing for last Saturday, so like 11 days or whatever it is. So it's quite short lived at the minute. So I think what you're going to see is the Fed just choose to not. They have their next meeting this time next week. So I think what they'll say is it's just very early days. We need to see if the price of oil is going to stay elevated. Our bias will be to look through this, see it as transitory, unless it's a more drawn out, prolonged conflict, and then we would worry about the higher price of oil, making its way into core inflation, showing up in core inflation, and that would be a more considerable reason for us to stay on hold for much longer.
Hmm.
I still don't think they'll talk about rate hikes. I don't think that's on the table, or they're even considering it, because I just think the market is much. The labour market, for instance, is much weaker than people give it credit for. Even though you do get we have had some stronger headline numbers, even though the last number was obviously terrible. But just generally speaking, job quits is down, hiring, job advertisement, job openings is trending down. So it's not like what it was like in 2022, where you had a stronger labour market. Now you don't really have that stronger labour market.
That makes sense. So are you saying rate hikes are off the table or unlikely? Because if they're still on the table but unlikely, what would we have to see for them to pull that trigger?
I think they're actually just off the table, to be honest,
Okay.
because I think a neutral rate is 3%. So if they're 3.5, 3.75%, they're 50 to 75 basis points still restrictive. Which, if they think this issue is a transitory issue, then they can just say we'll stay where we are for a while, keep monitoring it, but we're actually well positioned to deal with this without needing to raise the rates. And I think it would just send a diabolical message to markets. In the early phase, it'd probably be considered a policy mistake. Should it get further down the line, that's when they could think about it a little bit more if oil stayed really elevated. Um, but no, I just think that's off the table. For now, at least, that's definitely off the table, or most very, very likely off the table, and it probably is going to remain that way.
That makes sense. Let's take a look at the markets as a whole. They seem to have had a pretty muted reaction thus far to this print, but that was to be expected because, of course, a lot of this was already priced in. People are already aware that inflation is going to become an issue, but this print was not going to reflect that. Talk to me about what will happen to high risk assets like crypto and stocks over the coming months versus what will happen to assets like gold and bonds over the next couple of months if things do trend in the direction that we expect with a 3 to 3.5% inflation print around July.
Um, Again, it will still be partially looked through, but um, ultimately, it's not good. Like, in short and sweet, it's not good for risk assets, and you're going to see things like dollar slightly higher. But again, it's in a sort of major downtrend. But you're going to probably see dollar slightly higher, and you are going to see bond yields higher. They've already moved a ton. I mean, the US 2 year has gone from, I think, on Tuesday the 10th of March, it was 3.53%, and it's now 3.63%, say. But really, if you go back to the very start of March, it was down to 3.37%. So it's moved up like 25 basis points in the course of 10 days or so. So when you're looking at that, that is pricing out whatever cut that was being priced in. That's definitely now being priced out, and it's essentially pricing in higher inflation and higher issuance. So if you're in a war, the government will need to fund that war by issuing more debt, and therefore, why buy the bond today that generates a 3.4% yield when I can wait for a month's time and buy that same bond and it generated me a 3.7% yield? So it's just greater issuance coming online and greater inflation. So you're going to get yields up again. That's a tightening of financial conditions, again, just not supportive for risk assets. So my view is quite strong at the minute. Even though Bitcoin seems quite suppressed to the downside, I still think we just chop for a while. I think equities have room to roll over. I think Bitcoin just chops for a while, but I think it generally trends towards that 50, 60K zone. There's a ton of confluence between a lot of the on-chain levels in there, like key cost basis levels. You have your realized price in there, production cost in there. The electoral cost, I think, is actually below 50, or is at 50 now. It's like 49 to 50. So yeah, I think just that whole backdrop sets you up to just chop, because we're so low already, prices so low already, is that it sets you up just to chop for a while, but you're probably going to get these drains lower that probably put in higher lows in terms of their oversold conditions, similar to what you saw between June 2022 and November 2022, where price made new lows, but the indicators didn't make new lows. So I think you see something like that. And it's a buying opportunity, that stuff.
Yeah, it makes sense. But Bitcoin's trading at around 70K right now. We've said that the 50s are on the table. At the same
Yeah.
time, we're saying things are likely to remain range bound. What is that range you're referring to when you say range bound? And what's the difference between us ranging between that range and pulling back to 55? As for me, I would not consider something going from 70K to 55K around some of these key cost basis levels as range bound. I would say this is a big dip.
Um, so I would say the range bound area is like 55 to 74, which I do agree with you is a big range. but I do think it's all between the I think the range is like 63 to 74, but I think if you break below 63, you start getting bids in the low 60s and the high 50s, and maybe even into the mid 50s if it gets there. So that's like your buying zone. If price were to break out of 74, then you could probably definitely get a counter trend rally. But at this moment in time, I don't think it looks too likely. I don't know if the conditions are there for this to go and get a substantial rally from 74k to 80k. And, you know, even if I think price has held up quite well underneath all this, to get to see a bullish chart again, like a headline zoomed out bullish chart, price needs to get above like 86, even 90k for it to be for a move back to like 120. So I don't know. And just with so you can put invalidation levels on it if you want. But I just think with the whole picture that's there, you need to see like a significant change in the whole picture. So i.e. the war situation, what that does for rate cuts, general liquidity in the markets, and then the sort of timing of all that, to be honest. So yeah, it is a big range, but I think you just sit tight in the range. I think Bitcoin in late 2022, second half of 2022 was range bound from like 16k to 23k, which is an even bigger range. You know, you're talking about I don't know what that is, like 35% range, but they're all
Mm.
they're all magnificent buys. If you bought that range, it was all like great buys when you look further out. I think we're going to look at like 65 to 55, maybe a bit lower, 52 to 65 as that range. But I just don't think buying at 70, 71 is the area to buy. I think if you're still holding, it's an opportunity to offload a little bit. And if you get 74 to say 78, somewhere in there, that's the opportunity to offload with a bit more size. That's my view.
Okay, that makes a lot of sense. Of course, a lot of this comes down to narrative. We saw oil have one of its biggest intraday swings ever a couple of days back, and a lot of this was just
Yeah.
spurred on by Trump making a couple of comments that just were not founded in pretty much anything, but the markets reacted so heavily, even though many a time Trump's messaging, everyone knows it doesn't land in reality, right? That's just the truth, but they still act on it. So, I guess it's going to be very hard to predict the market, which is why it's good to keep such a wide range too, but also keep an open
Yeah.
mind to something pushing us up. But yeah, it's very interesting. Could we circle back to discuss bonds a little bit? I know it's a little unrelated to inflation, but we did say what would happen to bonds compared to risky assets if inflation continues to go up. Could we touch on the fundamentals of a bond, right? If someone goes in and looks at the definition of a bond, a lot of it comes down to, look, you're making a handshake deal. It's a bond, it's an agreement. Could you give us the basics of a bond? So let's say a beginner can start to understand why they need to be tracking the price and the yield of a bond, especially in a market like this.
Um. So okay. So I would say in terms of why they need to track it, bond yields, especially government bond yields, going higher is a tightening of financial conditions. Bond yields going lower is a loosening of financial conditions. A tightening of financial conditions is usually historically bad for risk assets. An easing of financial conditions, i.e., bond yield lower, is positive for risk assets. If the US government issues a bond for $100 and the yield is 3%, for instance, it's not 3%, but let's say it is 3% just for ease of numbers. You give them $100 and they say it's a 10-year bond. They give you 3% every year for the next 10 years. That bond will still trade at a price. It might not trade at $100 anymore. It might trade at 99, 98, whatever. If if the conditions are there in the world where bond yields go higher, the price of that bond will trade lower. So when the Iran-US war kicked off, the price of bonds yields went higher because prices went lower. So people are selling down their bonds because there's higher inflation, or there's going to be higher inflation because of higher oil prices. If
Mhm.
there's going to be higher inflation, you won't if there's going to be higher inflation, the Fed are unlikely to cut rates. Yields are going to go higher. And if there's just higher inflation, there's a greater term premium that's going to be demanded by the bond investor. So again, yields higher. If it's due to a war, the government will look to raise more debt, raise more money to fund that war. So they will issue more bonds. Now, if more supply is coming online,
Mm,
then the bond you hold, the price of that bond is going to go down. So the yields are going to go higher. So I would then sell that bond today to buy a new bond back in 2 months' time, rather than hold a bond that pays me 3% today. I might buy a bond in 2 months' time that then pay me 4% because there's so much more issuance has come on since then. So that's the but but going back to my first point, it's more about the tightening or easing in financial conditions that the effects that yields have. That is the like key part for risk assets.
okay, and is there an inverse relationship between the bond price and the bond yield?
Yeah. So bond price down, yields up. Bond price up, yields down.
Okay, and with the current circumstances we're in, the government will need to raise debt, which means they'll basically, let's just use the word print, they'll print more bonds. As supply of bonds increase, price goes down. However, you should see an increase in yield if price goes down. However, because inflation is also increasing, if yields don't perform higher than inflation, demand for bonds also go down. So that's a very delicate game they're also playing. When we look at the Fed, they're very much in control of interest rates. This is the government side of things, isn't it?
Yeah, so yeah, it's slightly different. Bonds that are in the market, their price will change, but the government will always issue a $100 bill as the bond
Mm.
value. But the whole point is that if you own a bond today at 3% and the price is $100, you would and you think this war is going to kick off, you'd sell it today because you can buy a bond for $100 in a month's time that generates a 4% yield, for instance. Don't get me wrong, it won't ever go as much as that. Like the spread wouldn't be as extreme as that, but yeah, that's the general principle. And what that then does is if it's a rate that's being paid, so um, it's the cost of borrowing money. So if the cost of borrowing money is increasing, then that's bad for risk assets. That's I would say is the main takeaway for a listener. So if bond yields going higher, risk assets should come down, which is why I think, even though I think Bitcoin's actually done relatively okay, to be
Mm.
honest, but equities have struggled a bit, but have held up, but have struggled. They're not finding new upside, for instance. So yeah.
Yeah, that makes sense. That gave us a good idea of where bonds are headed. We've already established Bitcoin and the rest of the crypto market. Let's talk about gold a little bit because people have always latched onto the narrative of Bitcoin as gold 2.0. And part of me thinks perhaps that's why Bitcoin is holding up so well. We see the power of a narrative. And a narrative can't outperform macro in the longer term, but we have seen the narrative play a part in this. We saw this on the negative with quantum. So, what are we seeing for gold over the next few months throughout this war? People often say, hey, look, gold always performs in times like this, and that makes sense. But there seemed to be a massive build-up and a huge run for gold over the last year. Gold's been running like crazy anyway.
Yeah.
So if I were a guy who was saying, you know what, I want to buy something to, preserve my capital just in case this war gets worse, gold would seem like a no-brainer. But it already moves so much that it's less appealing to me because although I think maybe, we can hit 6,000 or something, how much further can we go up? With gold, it's already ran, whereas everything else seems undervalued in comparison, Bitcoin being one of them, especially if you subscribe to the gold 2.0 narrative.
Yeah, I think I said this on a stream last week. I think gold is in that range between gold between 4,600 and 5,100 is the new range that was April 2024 to like October 2024. Need to get the chart up.
Hmm.
April 2020, no, sorry, April 2025, sorry, to August 2025. And price went mostly between 3,100 and 3,400 before it then broke out in late August 2025 and went from 3,400 to 4,400 basically by mid October. So it was a quick move. I think gold is now doing something similar between sort of 4,700 and 5,100, 5,200. And I think that can be the case for the next 3, 4 months. If you get pullbacks into 4.6 to 4.8, I think gold is a buy to then look to sell at 6,000 by year end. So, you can go and get 25% upside if you go and buy at 5,000 or 4,800 and go and sell it at 6,000 by year end. So I think that's like the play for gold. I think Bitcoin just struggles a little bit because of this quantum threat, regardless of how like real or whatever people say, or I do think it's real. I do think it is a big problem that keeps big money on the sides for now, or not wanting to get serious exposure, because I think why would they want to buy an asset that has gold? Bitcoin is better than gold in many ways as well, but why would you go and buy this asset for if you're sovereign, for instance? Why would you buy this asset where 20% of the supply might just come back online like that because of a quantum hack, for instance, that brings these coins back on, that are then basically just market dumped? It's not an attractive setup for a sovereign. So I think that's what's keeping them more towards gold at this moment in time. But long term, I think once this quantum threat, or there's a solution for this quantum threat that is being enacted, I think then the trade will come back to Bitcoin. Um, and I think that's a trade that plays out for the next like 10, 12, 15 years. But I just think Bitcoin's in this like vulnerable bit at the moment where there is not a clear quantum solution, and gold is still the go-to for that kind of, if you're talking about that safe haven trade.
Yeah, it's interesting. I have a few big picture thoughts on that too. I do think with gold, people often neglect the idea of like, hey, we have space travel now. We are flying into space. We can mine meteorites, and at any point, we may be able to tap into an insane supply of gold. People say gold is scarce, and we mine about 2% every year. It's like we live in a different world now. We're shooting rockets into space. Right now, it might sound a bit of a crazy theory that they're going to find asteroids with billions of tons of gold and start mining it, but it's still a possibility. Um, I know there's a planet out there that rains diamonds. I don't recall the name, but it's, this is a reality. And we've seen with certain markets like the diamond market, it's been cornered, by a couple of companies like De Beers, where they're not really valuable. It's just the supply is like controlled. I do
Yeah,
think you have to also look at the lab grown diamond market too. That's completely shattered the regular diamond market. And I think with gold, um, with these solid materials, I think I think maybe the scarcity and the security and the value proposition is a bit overstated. And the same way Bitcoin's getting hammered right now with the quantum threat, I do think gold will have its day inevitably. And look, let's shoot straight. People would have said Gulf real estate was the most secure in the world. But in a matter of weeks, something that everyone knew was a potential possibility but didn't foresee happening has shattered everyone's worldview. So I do think things change on a dime, and I wouldn't be surprised for Bitcoin to have a narrative shift like this regarding quantum and things get crazy. And the same thing on the inverse for gold. Touching on gold quickly though, is it the same setup for silver that you shared for gold?
no, they got
What's the name about
completely
silver?
different. They've just got completely different fundamentals. Like, gold is being bought up by central banks, sovereigns. Silver isn't. Silver is the speculative. It's sort of the speculative version of gold. It's for traders and things like that. It's not. It's not got the same drivers that gold has, which is the central bank buying and the sovereign buying.
Okay, yeah, that makes sense. Trying to think about all the different assets that are on the table for people to get exposure to. Right now, crypto's holding up very well, which is great. I'm very happy to see that. Obviously, it's a crypto team. I do hope your thesis of things coming down in their cost basis levels holds true. I would love to capitalize on a dip buying opportunity. I do think staggered, almost laddered bids is the way to go for most people if they're watching. And if someone wants to dabble beyond crypto, gold seems like a bit of a no-brainer. I think people have to be very careful, as we saw with oil. It seemed like such a no-brainer play too, and it still does. The strait is not open. These reserves that are coming into the market, they're a temporary solution, and they're not going to last. And I think every big economist out there sees oil being higher a few weeks and a few months from today than today.
A
However, I
few
don't think
weeks,
anyone
definitely. Yeah,
saw a $40 swing off of a
yeah,
couple of Trump messages that were not founded in reality. I don't think anyone
yeah.
saw that. So you have to be careful, especially with leverage. As far as right now, Tom, how are you trading the markets? Are you playing with leverage? Are you sitting on side? Are you swing trading? What's the Tom playbook?
I'm very, 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 very heavy cash, and I just take trade opportunities when I see them. I should have played oil the other week. I think we knew, like I sort of said it internally as well, like when those Geneva strikes broke down, the negotiations in Geneva broke down, that something was going to happen that week. I did feel that something was going to happen the weekend before, but negotiations were still ongoing. But when those, it was on the Friday, I believe, that the negotiations in Geneva broke down. It seemed quite like very likely that something was going to happen, and especially on the weekend because stock market is closed. So that's when Trump and the Israelis were going to go for it. So oil did seem like just such an obvious long. And I saw a few people say that the spike up in oil was a fade when it went to like mid 80s, and I think we were saying this will consolidate in the mid 80s, which it did, and then spike higher again as the Iranians can close the strait down, cause big damage for not a lot of output, not a lot of effort in terms of it costs a few drones to bomb to missile into a few ships, and that's basically it. And then no ship will pass through. So it seemed an obvious trade. I should have taken that. I didn't take it because it's not my. It's not. I'm playing it for a small bounce today, to be honest. But I think I can see it back at 100. But again, I'm playing tiny size on it because it's just not. It's not my oil is not my strong point. I'd pay a lot of attention to it, especially now. But it's not my strong point. I think generally risk assets aren't a good hold for this next 6 months. Um, I think if anything, I think people undervalue being in cash and having cash available when an I think every year or 2 years there's these opportunities that are just standout opportunities to really throw the kitchen sink at it. Like when FTX went down, that was just a real obvious trade to go in and buy Bitcoin, but people have just run out, like people in the ecosystem especially, and just run out of cash. So I think being overweight cash and just waiting for these opportunities, and I don't think this to then buy it is the play. And I don't think we're in one of those opportunities which is like, oh, the price is just going to keep grinding higher, and he's going to have missed it. I don't think we're in that. And if we are in that, we can pivot. But I think you need equities to reclaim their highs. I don't think that's likely. I think Bitcoin needs to reclaim like 80, 85K and to consolidate there, the flows to be constructive, rate cuts to be priced to be back on the table, for there to be several of them, not back to back, but cuts, pause, cut, pause, etc., and to have this sort of measured approach that cuts are going to happen. So I think a lot of the picture, there needs to be this huge change in a lot of dynamics within
Mhm.
the whole picture, and I just can't see any of it being like even close to favourable at the moment. If anything, I think the picture is actually worsening, as mental as that sounds, because it seems pretty diabolical at the minute. But so that's mostly the way I'm looking at it. Um, Heavy cash and just playing trade opportunities. If I think we can get a bounce, I rely on my feeling quite a lot. But I can cut out the trade very very quickly. I could be in a trade at 10 a.m. and be out of it by the evening if I feel like it should have had a positive day or something like this. But ultimately, I think it's really undervalued being heavy in cash and sitting and waiting for the right opportunities, even if that means you've got to wait another 2 to 6 months.
Yeah, absolutely. Very interesting. I agree with you. I think cash is king right now. I think there's a level of psyoping that happens within crypto. about how you should not be holding any cash, it's being eaten by inflation, etc. And it's true to an extent, but if your portfolio gets blasted 40% down, and inflation's eating you up 3%, 2.4%, doesn't sound too bad to me. So I agree and I echo that sentiment. And yeah, I think it's difficult depending on your positions. If you're already down quite heavily, then you need to assess like how do I exit to have cash on side, unless you have a source of cash coming in which case perhaps just look for very selective exposure. Tom, while we were on the call, um, a factoid came out by the Wall Street Journal that Iran is exporting more oil through the Strait than before the war. If this is true, how does this play into the big picture? And who are they transporting it to? It's China, I believe it's some of these Asian countries. So
Yeah.
how does this impact things? And on in the same breath that Iran is making things difficult for the US from this economic point of view, if the US steps in and does the same thing, it's inexpensive to sink a ship, and the US decides to play that game too, how would that affect some of the countries that Iran is exporting to? And could that make the war even more sticky in a sense?
Well, I think simply put, it's just helping trade partners. So Iran is helping trade partners like China. They've got partnerships with Russia. So it just puts more pressure on the US in terms of. I mean, the US produces a lot of oil as well, but they're not in a net excess. What they produce,
Mm.
they consume. So they're not taking advantage of higher oil prices. If anything, the Iranians are taking advantage of slightly higher prices, even though the Chinese don't pay the full whack. But it helps the Chinese, and it doesn't help the Americans because they are fighting the inflation problem where the Chinese won't be fighting the problem as severely. I think that's mostly that in a nutshell.
Yeah, no, that makes a lot of sense. Tom, thank you very much. I feel like we hit everything. If you were to leave the watchers with any singular thing based off of today's inflation data, what would that be?
Um, just chill out for a bit because I don't think even if we do see a small move up in price, I think that's all it will be. And to remain patient, the time will come for more aggressive buying. Um, I think I think don't rush to make money or anything like that. Like the right time will come, and when that right time does come, you can really go for it. The inflation thing today, I think, doesn't impact it a ton. We know what the outlook is because of what's going on with the war. So there's no rush today. There's going to be
Mm.
negative prints to come down the line in the coming months. Buy into that rather than today.
That makes sense. Well, Tom, thank you very much. To everyone watching, thank you very much. Also, if you want more of these, please follow us on Twitter, subscribe to us on YouTube, check out Kryptonite Pro. If you want more one-to-one services with me and Tom and the rest of the team, then shoot us a DM and we can discuss that too. But yeah, we'll continue to cover. We have a big update, you said, Tom, Thursday, Friday coming out.
Yeah.
And what will we cover in that big update?
It's just a market update. So we're essentially covering everything that we see, anything that we see that is important. That's It's about looking at absolutely everything and then whittling down to what is the key driver of price or the next key driver of price for prices moving up or prices moving lower or are prices just going to stay flat? And if they are going to stay flat, why are they going to stay flat? And what's the driver beyond that? So it's identifying what are the next key movers of the market.
Amazing. Well, that's it, my friend. Thank you very much.